Welcome to the deep dive. Today, we're going to be looking at the financial health of Indigo,
Okay.
India's largest airline.
Right.
And we're going to be using a couple of their documents.
Yeah.
One is a letter to the National Stock Exchange and Bombay Stock Exchange announcing their financial results
Right.
for Q2 of financial year 2025.
Gotcha.
And we're also going to be looking at their earnings presentation.
Okay.
That summarizes the key takeaways
All right.
of those results.
Sounds good.
Our mission today is to kind of quickly understand how Indigo is performing financially, especially given their significant growth.
Yeah, I think you'll find their recent performance very interesting, especially given their aggressive growth strategy.
Sure. And to illustrate this,
Yeah.
get this. Indigo is currently operating a massive 410 aircraft.
Wow.
Which is a huge jump from 334 just last year.
That's a big increase.
Yeah.
Which really highlights the scale of their growth.
Right.
Think about it, adding 76 aircraft to their fleet in a single year.
Yeah.
And on top of that, they've also added 9 new domestic destinations and 2 international destinations during the same period.
Wow, that is a lot of new routes.
Yeah.
You have to admire their ambition. But all this expansion begs the question, is it financially sustainable?
That's an important question, and when we look at the numbers, there's a fascinating contrast.
Right.
Their revenue from operations is up by a healthy 13.6%, reaching a total of INR 169,696 million for the quarter.
Okay.
However, their profit before tax tells a very different story.
Oh.
It has swung dramatically from a profit of INR 1,891 million last year to a loss of INR 9,071 million this year.
More revenue but less profit?
Yeah.
That's a bit counterintuitive. Can you help unpack that?
Absolutely. It all comes down to 2 key metrics.
Okay.
RASK and CASK.
Okay.
RASK stands for revenue per available seat kilometer.
Right.
Imagine each seat on a plane flying 1 kilometer.
Okay.
RASK is a measure of how much money the airline makes from that single seat over that distance.
Got it. So it's a measure of how efficiently they're filling seats and generating revenue.
Exactly. Now, CASK stands for cost per available seat kilometer.
Right.
It's essentially the cost of flying 1 seat for 1 kilometer.
So if I'm following correctly, Indigo's issue is that while their RS went up, meaning they earn more per seat kilometer, their CASK increased even more.
Exactly.
Basically, their costs outpaced their revenue growth.
That's exactly right, and that's the core reason behind their profit decline this quarter.
Okay.
To understand this better, let's delve into the specifics of their costs.
All right.
There's some good news here.
Okay.
Fuel costs, which are often a major expense for airlines, are actually down compared to last year.
That's definitely a relief, but I'm sensing there's a but coming.
You're right. While fuel costs have gone down, other costs have seen a dramatic increase.
Like what?
The most striking is a 290.5% increase in aircraft and engine rentals.
290.5%?
Yeah.
That's a massive leap. What's going on there?
It's all tied to Indigo's rapid expansion. To accommodate those new routes and the increased passenger capacity, they're leasing many more aircraft.
Right.
And this, of course, comes with the hefty price tag.
Ah, that makes sense. It seems their aggressive growth strategy is a double-edged sword. More revenue, but the costs of that growth are cutting into their profits.
Precisely. It makes you wonder if they're experiencing short-term pain for potential long-term gain.
Interesting point. Let's take a closer look at some of these other rising costs.
Okay.
What else stands out?
Well, beyond aircraft rentals, supplementary rentals and aircraft repair and maintenance costs have also climbed.
Okay.
Although not as dramatically, they're up 29.6%.
That makes sense. More planes inevitably mean more maintenance, right?
Exactly. And then there are airport fees and charges, which have also seen a significant jump, increasing by 41.1%. This likely reflects the expansion into new destinations and the associated costs at those airports.
Yeah, it's really fascinating to see how all these pieces of the puzzle fit together.
Yeah.
Each new route, each added aircraft contributes to the overall financial picture.
Yes, everything is interconnected. Another notable cost increase, albeit on a slightly smaller scale, is a 21.5% rise in employee costs.
I imagine that's just part and parcel of expanding their operations, isn't it?
Yes, that's right. More flights,
Yeah.
more routes, and more passengers generally require additional staff across various departments of the company.
Okay, so we've seen a lot of costs going up, but I do recall one positive number, a 61% decrease in foreign exchange loss.
Yeah.
What's the story there?
That's an interesting one. It probably reflects the relative stability of the exchange rate between the U.S. dollar and the Indian rupee during this quarter.
Okay.
A stable exchange rate can benefit airlines that lease their aircraft in U.S. dollars, as it reduces the uncertainty that comes with currency fluctuations.
That's a good point. So if we zoom out and look the bigger picture, what does all of this tell us about Indigo's strategy?
Well, it's pretty clear that they're prioritizing growth, even if it means sacrificing some short-term profitability.
That's evident from their performance this quarter, and their recent investment of INR 295 crore in a travel-focused investment fund further supports that idea.
Absolutely. This move suggests they're thinking beyond simply operating flights and are strategically positioning themselves within the broader travel ecosystem.
So it seems they're playing the long game.
It certainly appears that way, but the question remains, is this a risky gamble or a smart forward-thinking move to answer? That we need to consider the challenges and opportunities that lie ahead for Indigo. We'll delve into those right after we touch on their other costs and their financial health.
Right, we still need to look at a couple more cost items like finance costs and what they're paying to borrow money, plus what's the deal with depreciation and amortization expenses.
Yeah,
They seem to have gone up quite a bit too. We'll get into all of that when we come back. Stay with us.
we'll be right back. Welcome back. Before we get into the challenges and opportunities for Indigo, let's wrap up our look at their costs. We were talking about employee costs before the break.
Okay.
Interestingly, their finance costs has also risen up 21.4%.
Finance costs, meaning what they're paying to borrow money.
Yeah.
What does that tell us?
It could indicate that they're taking on more debt to finance their growth, which we'll need to consider when evaluating their overall financial health.
That makes sense. What else is there in this cost breakdown?
Well, their depreciation and amortization expenses have increased substantially, up by 34.8%.
Can you remind me what those terms mean again?
Of course, think of it like this: depreciation is basically the cost of their planes wearing out over time. Amortization applies the same concept to things that aren't physical objects like software or patents.
Ah, I see. So the increase in these expenses is likely due to their growing fleet of aircraft.
Precisely, it's a natural part of operating an airline.
Yeah.
But it contributes to their overall expenses. Now, before we move on, let's take a quick look at Indigo's financial health.
Okay, time for a financial checkup. What's the diagnosis?
The good news is, despite the dip in profit, they still have a strong cash position of INR 393,419 million.
That sounds like a decent cushion.
It is, but on the other hand, their total debt has increased significantly to INR 592,369 million, up almost 20% from the same period last year.
Okay.
To put it into perspective, their debt is now equal to the cost of about 150 of their newest aircraft.
Wow, that's a lot of debt, so that's something to keep an eye on.
Definitely. While debt isn't always a bad thing, and many companies use it to finance growth, it's crucial for them to manage that debt effectively and generate enough revenue to cover their obligations.
All right, so we've covered the costs and gotten a glimpse of their overall financial health. Now let's turn our attention to the challenges and opportunities facing Indigo. It can't all be smooth sailing even for India's biggest airline, right? What kind of headwinds are they facing?
Well, as we've discussed, one major challenge is rising costs across many parts of their business. But it's not just internal factors they need to worry about. They're also dealing with potential regulatory hurdles.
Oh, bureaucracy. That's never fun. What sort of hurdles are we talking about?
For instance, they're currently in a dispute with authorities over import taxes on repaired aircraft parts.
So they send a part overseas for repair, bring it back to India, and suddenly get hit with unexpected taxes.
Precisely. And these aren't insignificant amounts either. This quarter alone, they've already paid INR 738 million in taxes under protest. That brings the total to a whopping INR 17,208 million since this dispute began.
That's a massive sum. It sounds like a real headache for them.
Indeed. And there's another layer of complexity. They're also grappling with the tax implications of incentives they received from aircraft manufacturers.
So the tax authorities are questioning how these incentives are being treated, potentially leading to even more tax liability.
Exactly. If these disputes don't go in their favor, it could significantly impact their financial plans.
It seems like they're navigating a bit of a financial minefield.
And these challenges aren't unique to Indigo. They reflect the turbulent times the global aviation industry is facing, with many airlines grappling with rising costs, regulatory uncertainties, and a challenging economic climate.
Okay, so there are definitely some hurdles to overcome, but I imagine there are opportunities out there as well, right?
Absolutely. The Indian aviation market is one of the fastest growing in the world, with a rapidly expanding middle class and increasing demand for air travel. The potential for growth is substantial.
So if Indigo can successfully navigate these challenges, they're well positioned to capitalize on this growth.
Exactly. They have a lot going for them. A vast network, strong brand recognition, and operational efficiency, all give them a competitive edge. However, we need to circle back to their financial health and consider whether their current strategy is putting them at risk in the long term.
You're right. So let's dig a little deeper into that. Is this growth spurt sustainable? What does their investment in the travel fund tell us about their long-term vision? We'll explore those questions and more when we return.
Stay tuned.
We're back for the final leg of our deep dive into Indigo's second quarter performance.
Okay.
Before the break, we were discussing their financial health and the sustainability of their growth strategy.
Right.
You mentioned their investment in a travel fund. What's the significance of that move?
It's a fascinating development. By investing INR 295 core in a travel-focused investment fund, Indigo is signaling that they're not just content with being an airline.
Right.
They're looking to play a larger role in the broader travel ecosystem.
So it's not just about flying people from point A to point B anymore. They're
Right.
thinking bigger.
Exactly. This move could have several potential benefits. It allows them to diversify their revenue streams, potentially reducing their reliance on airline operations alone.
Okay.
It also gives them a chance to invest in innovative travel technologies and startups, which could give them a competitive edge in the long run.
It sounds like a forward-thinking strategy, but are there any risks involved?
Of course, there's always a risk that the investments won't pan out as expected. The travel industry is notoriously volatile, and there's no guarantee that these startups will succeed.
So it's a calculated gamble?
Precisely. And it brings us to another crucial aspect we haven't discussed yet.
What's that?
Their competition.
Ah, yes, the battle for the Indian skies. Who are they up against in this space?
The Indian aviation market is fiercely competitive with several players vying for market share.
Right.
You have established full-service carriers like Air India, which, as you may know, was recently acquired by the Tata Group and is undergoing a major transformation.
Right, I've heard about that.
And then you have the low-cost carriers like SpiceJet Go First and AirAsia India, all competing for a piece of the pie.
So it's a pretty crowded playing field.
Right.
How does Indigo stack up against these rivals? What are their strengths and weaknesses?
Well, historically, Indigo has consistently held the largest market share in India, often exceeding 50%. Their focus on operational efficiency, punctuality, and affordable fares has resonated with travelers. That's been their key strength.
So they have a solid track record, but can they maintain that dominance in the face of such intense competition?
That's the million-dollar question. Their strategy of aggressive expansion is clearly aimed at solidifying their position. But as we've seen, it also carries financial risks.
Yes, those costs are a real concern. How are their competitors responding to Indigo's expansion?
They're not standing still. Air India, under the Tata Group, is making ambitious moves to expand its fleet, and network SpiceJet and Go First are also vying for a larger share of the market. The competitive landscape is constantly evolving.
So the pressure is on for Indigo to stay ahead of the curve.
Absolutely. And that brings us to our final thought for you today.
Okay.
As you continue to follow Indigo's journey, we want you to consider this in a market as dynamic and competitive as Indian aviation. Can any single airline realistically dominate indefinitely? Or are we likely to see a shift towards a more balanced distribution of market share among multiple players? What do you think?
That's a great question to ponder. It reminds us that even the most successful companies must constantly adapt and evolve to stay ahead in a rapidly changing world.
Well said, and that's what makes following business stories like this so fascinating. The constant interplay of strategy, execution, and external forces makes for a compelling narrative.
Indeed. Well, folks, that wraps up our deep dive into Indigo's second quarter performance for financial year 2025. We hope you found this exploration insightful and maybe even a bit thrilling. We encourage you to keep exploring the world of airline finance and to stay tuned for Indigo's next move. Until next time.
Thanks for listening.